Yeah, all right, good evening, everybody. If you can, if you can hear my voice and see my face, I like you to just type one in the comment section. If you can see me, you can hear my voice. Just type one in the comment section. All right, if you can see me, you can hear my voice. I like to just type one in the comment section. One who are there now. If you can see me, you can hear my voice. Just type one in the comment section. Type one. Just type one in the comment section. If you can see me, you can hear my voice. Just type one in the comment section. All right, beautiful, beautiful. As soon as I see one person, so I want to continue so that we can cover so much within the shortest period of time. This class will last maximum of 45 minutes. Today is the third day in our training. Okay, I'm used to training like this, and I actually enjoy it. I enjoy it because of the testimony I see, I hear from people, from my students, and also I lose nothing for teaching. I was telling you yesterday that the forex market has 7 trillion US dollar turnover every day. So if I make my money, you make your money. The money you're making does not affect the money I'm making. So there is no need for competition. The market is so large. The market is so large that all of us can make profit at the same time. And I'm always excited about that. See, even when you make money, I'm not intimidated. When I make money, don't be intimidated. And that is why, you see, I want you to look at yourself, give yourself time to grow. On day one, I told you that forex has been there. Forex has been here in a long time, and forex will continue to be. Financial market will continue to be. And I told you that as long as we have intertrade, we have country trading with other countries, there will always be forex. Forget it. So give yourself time to learn. This is not Ponzi. This is not CBET. This is not MMM. This is not one of those online way of betting that come and go. Now, this is forex. This is financial market. It has come to stay. So give yourself time. If I were you, I would give myself like 3, 4, 6 months, 3, 4 months, 3 months, 4 months, 6 months. In fact, I can give myself 1 year to understand perfectly the market. So there's no rushing time. There's no need to rush yourself to you start making money tomorrow. Majority of you in this class are undergraduate, and that makes it very beautiful. So you have time between now. Give yourself like 6 months. The next 6 months, I'm going to study. I'm going to learn. I'm going to learn. I'm going to learn. So then you're going to be engaging. You engage yourself. You will practice. You will do. I'll start giving assignment from tomorrow. From tomorrow, I'll start giving you assignment. I gave you assignment yesterday. The assignment yesterday was you open your account with all those brokers. You go to our website, www.apicts.net. Okay, then you open deriv account, then you open HFM account, then you open extended account. All these three accounts, I want you to open them because I want you to trade different instruments on different brokers, so that I'll be able to separate your your fund. So, or one way or the other, we shall need all these account in the future. So now give yourself time to study. Give yourself time. Give yourself time. There's always the market is always there. You always have enough time to study and to grow and to grow. And that's very beautiful. And that's one thing that you must never forget. Never forget that the market is always there and you always have enough time to grow. So yesterday's and every single time will come like this, we always go deeper. Don't forget, I'm following a syllabus. My syllabus has been systematically arranged, systematically arranged that will move from one phase to another phase, from one study to another study. And every study has something to do with the overall understanding of the financial market. Every single study, every single class we're going to be holding has something to do with the overall skill that you need to acquire to make financial decision in making profit from the market. So beautiful. So let me quickly take you to my slide today. I always love to take you slide, and so we'll continue from where we stopped yesterday. Oh boy, I'm always excited. All right. Can you see my screen? If you can see my screen, please type 2 in the comment section. If you can see my screen, type 2 in the comment section. If you can see my screen, you can see which currency are traded. Just type 2 in the comment section. I want to be sure you are seeing my screen. If you can see my screen now, just type 2 in the comment section. If you can see my screen, just type 2 in the comment section. Type 2. I want to be sure you are seeing my screen so that we can be on the same page. All right. Let's continue. I said this is the major currency pairs that are traded all over the world. They have the highest volatility, they have the highest liquidity. Okay? And these are the one I want you to focus on. Euro USD, USD JPY, GBP USD, Australian dollar versus United States dollar, United New Zealand dollar versus United States dollar, United States dollar versus Switzerland franc, and United States dollar versus Canadian dollars. And all these one together account for over 70% return over in the forex market. So important. And then aside those one, we also have other instruments. You have gold, we call them metals. You have gold, you have silver, you have futures, and then you have agriculture. Other agriculture, you have the cocoa, you have the sugar, you have a lot of other things under agriculture, And you have the commodities. You have the commodities under other instrument that you can share. But all of these one we're going to go into them later. So now when you have currency pairs, like I was showing you, yesterday, I said the currency you have on your left is the base currency. The one you have on your right is the quote currency. This is very important, especially during the news. When you check news, you go to forexfactory.com. Don't worry, we're going to get to all of those in details much later. But I just need to make reference now. So if you check Forex Factory, and Forex Factory tells you that by 2:30 p.m. there's going to be a news affecting USD. So if you want to trade news at that time, you will need to go out and select instrument that has USD, either as base currency or as quote currency. Okay? Now, if the result of the news eventually comes out, and if it favors if it favors USD, it means that USD will appreciate. That means people will start dropping the currency they have to buy USD. At such moment, at that particular moment, Euro USD will sell because because USD is a quote currency. And let me explain it in a simpler term. So you have Euro USD. When Euros USD is buying, that means it's appreciating. That means the value is increasing. That means everybody, the economy of that country is doing well. Euro economy is doing well. Okay? So when Euro USD is appreciating, it means that more people are buying Euro and they are selling USD. That means you are selling their USD to buy Euro. You're selling their USD to buy Euro. Don't forget the definition I gave you yesterday when we were defining Forex, that it is simultaneous buying and selling of currencies in order to make profit. You are buying one currency and selling another currency at the same time for the purpose of making profit. So this is an example of buying and selling of currency at the same time. So every time you are buying Euro USD, it means you are selling your USD to buy Euro. You are buying Euro USD. When you are buying Euro USD, it is Euro you are buying and you are selling the USD. When you are selling the USD, when you are selling Euro USD, it is the Euro you are also selling, but you are using your money to buy USD. You are selling the Euro that you have to buy USD. The focus is always on the base currency. The focus is always on the base currency. So when I'm buying Euro. When I'm selling Euro. When I'm buying Euro. Okay? That means I'm selling my USD to buy Euro. If I'm selling now, I'm selling my Euro to buy USD. So you're using the one on the left is always a base currency, the one on your right is always the quote currency. That means we use the quote currency to quote the value of the base currency. I want to believe that you understand that. Okay? I want to believe that you understand that. Now, the next on my slide is risk to reward ratio. Risk to reward ratio. All of this I'm still going to be explaining deeper to you, but I want to establish it. The risk to reward ratio is what make trading forex very super interesting. I'm telling you, is what make trading forex super interesting. And when you understand risk to reward ratio, you enjoy forex. The people who say forex is a scam is because they don't understand the risk to reward ratio. And what do I mean by then? Do you know that you can trade forex? You can trade 10 times. Okay, I don't want to shift my window so that network is always lagging when you are changing from one window to another window. But just listen to my explanation. Risk to reward ratio. Talking about risk to reward ratio. Do you know that you can take 10 trades? You can take 10 trades, okay, and lose 7 times, and then you win only 3 times and you are still in profit. That is what makes forex sweet and very interesting. So imagine you have risk to reward ratio of 1 to 3. Risk to reward ratio of 1 to 3. What that means is that every time you are risking $10 in a market, you are targeting $30. Risk to reward ratio 1 to 3. 1 to 3. So when you are risking $1, you are targeting $3. When you're risking $100, you are targeting $300. So let's assume somebody is risking $100, and then to target $300. And every time is analyzing the market, he's only taking trade that can give him risk to reward ratio of about 1 to 3. Risk to reward ratio of 1 to 3. So how does that happen? If when he risks $100, just imagine he's risking $100 and then he lost 7 times. He lost 7 times. And then how much has he lost in total? Out of 10 times, he has lost $700. Let's assume that he wins only 3 times at a risk ratio of 1 to 3. He has won 300 times 3. He has won 900 times. If we subtract his loss from his profit, he's still in the profit of $200. That's how Forex works. That's how Forex works. So when you understand this trick, when you understand this aspect, you will love you will be able to stay longer in the market, and you can actually make consistent profit from the market. Now, the market presents us two categories of participators. Two categories of participators. In the market, we have the bulls and the bears. The bulls and the bear. The bulls are the buyers in the market. They're the buyers. And the word bulls come from, bull now. Bull is a male cow with horn, a male cow with horn. So when you see a male cow, when you see a bull is always fighting by pushing his prey from down up. Have you ever seen somebody that is experiencing the fight of a bull before? The bull always want to use the horn to carry it from down and take him up. Carry it from down and take him up. That's why they got the word bull. The word means from down up, from down up. So we say those who are buying in the market, they are called the bulls. And then when the market is buying, we say the market is bullish. The market is bullish. To be bullish means to buy. To bullish means to be going up. When the market is going up, we say it is bullish. So therefore, you'll be looking for opportunity to buy. In the forex market, you are either buying or selling. The essence of our training, therefore, is to know when to buy and when to sell. The buyers are called the bulls, where the sellers are called the bears. The bears also, the bear is the name of an animal. I know when the bears wants to fight, it uses the clone, its clones to attack its prey and tear the prey down. It's always pushing the prey to the downward side, always pushing the prey to the downward side. So that's where we come about the bulls and bear. The bulls, so when the market is selling, when it's making a series of lower high and lower low, we're going to get this very soon. We say the market is selling. You say the market is bearish. And so therefore, when the market is going down, 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 you are always looking for the opportunity to sell. So those are the two things we do in the market. We are either buying or selling, either bullish or bearish. Either going long or going short. Another word for buying is called to go long, and then to sell is to go short. To short the market, to go long on the market. To long the market. So those are technical terms that you need to be familiar with. So we have the bulls, we have the bears in the market. The bulls look like this, just like I explained to you. Is a male cow that uses the horn to fight. It pulled its prey from down up. So you can see the market is bullish. You can see this arrow now pointing to the upward side. So the market is bullish. So when the market is going up and up and up and up, it is said to be bullish market. So the buyers are in control. What it means that the buyers are in control. All that you need to be doing is to be looking for the opportunity to buy that market. I'm telling you. You'll be looking for the opportunity to buy the market. Be looking for opportunity to buy the market. Don't try to sell in a bullish market. These are powerful instructions. Don't try to sell. That is what I meant yesterday when I was telling you to type in the comment section, trend is my friend. Trend is my friend. I told you all those things will make sense to us later. So when I said I'm a retail trader, trend is my friend. That's exactly what I mean. So when the market is bullish, when the trend is going to the upside, I'm looking for opportunity to join the buy. How, where to join the buy are the things that are going to be paying a lot of attention to subsequently in our trainings. I can use the next couple of classes to explain to you where will you join the buy. Where will you join the buy to make profitable trades almost all the time in the market. So you join it when the market is going to the upside, you buy. And then the opposite also is true. The one beautiful thing about and this is how the uptrend market looks like. And the market is forming high. This is the high, this is the low, this is the high, this is the low, this is high, this is 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 high, this is low. When the market is forming series of higher highs and higher lows, it is said to be in an uptrend. Market is forming higher highs and higher lows, it is said to be in an uptrend. And that's remarkable. That's beautiful. You must always, so when you open your charts, and you begin to see that market is forming higher highs and higher lows. Higher high means this is high, this is low, this is high, this is low, and this is high, this is low, 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 this is high. When you are seeing higher highs and higher low like that, the market is an uptrend. All that you need to do is to, how do I enter a buy? How do I enter a buy? How do I join the buy? That is the skill that we're going to be spending a lot of time to acquire in this class, in this training. How do I join this buy? Where do I join this buy so that I can make money? Imagine this, imagine a lot of money that have been involved in this, in what you are seeing on my screen. The market is buying. So when the market is also, then look at this again. Market is forming the higher high and higher low, 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 higher high and higher low. Then it's said to be in an uptrend. If market is forming higher highs and higher low, we look for the opportunity to buy. We look for the opportunity to buy. This is a fundamental thing that every beginner must know. You need to understand. I was telling you yesterday, you are a retail trader. You cannot determine the trend of the market. I told you yesterday that a retail trader is like a diver that wants to ride on the waves of the sea. He cannot generate the waves of the sea. He waits for the waves to be formed, to be generated. Then he jumps on the wave. He begins to ride on the wave. That is how he can make profit on the market. So imagine the market maker are generating this wave. Imagine I told you yesterday who trade forex and why? The central banks, the commercial banks, the corporations. Can you still remember? If you were in class yesterday, I told you those that provide liquidity in the market, those that trade forex market, the central banks, the commercial banks, and then the large corporations. And I gave you an example of the global banks all over the world that make liquidity available in the market. They are the one that generate the higher high and higher low. But as a retail trader, you wait for the trend to be generated, for the trend to be determined by the market maker, then you jump on it like a diver. That is the secret of making profit. Now, if the market is bad and you are selling, hey, you will lose money. You will lose money. You will blow your account. And people who do that, they're the people that say forex is a scam. Easy forex is scam. Why? Because they are trying to sell in a bullish market, or they are trying to buy in a bearish market. So when the market is forming higher high and higher lows, 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 it is said to be bullish. Therefore, you should be looking for the opportunity to buy only and only. And I hope you understand that. Do you understand that? Are you still with me? Are you still with me in the class? All right, all right, all right. So let's continue. Now, look at the opposite. When you you also buy here. So let me go to the next slide. Okay. Then you have the bearish market. The bearish market is when the market is selling, when the market is going down, when the market is selling, bearish. The word bearish from the word bear, an animal that fights by pulling its prey to the downward side. So it's bearish. So therefore, on that kind of market, you are only looking for opportunity to short the market, opportunity to sell the market. You see what we're talking to here. What we're talking here. So you're selling, you're going down, you're selling, you're shorting the market, you're selling the market. And this is how the market looks like. So when you open your chart, and you are seeing that market is forming series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. Look at it now. Lower, this is high, this is high, this is high. This high is lower than this high, so it's called lower high. This high is lower than this high, lower high. So this is high, this is low. 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 So this high is lower than this high, it's called the lower high. This high is lower than this high, it's called the lower high. So they are all lower highs and lower lows because they're just getting lower than the previous one, getting lower than the previous one. Then this is low, this is low, this is low, this is low, this is low. This low is lower than this low, it's called lower low. This low is lower than this low, it's called lower low. This low is lower than this low, it's called lower low. So when the market is forming series of lower highs and lower lows, lower highs and lower low, lower highs and lower low, lower highs and lower low, it is said to be in a downtrend. So the market is selling. The market is selling. It's forming series of lower highs and lower lows. It is said to be in a downtrend. Therefore, we shall be looking for opportunities to sell. Period. Opportunity to sell. We shall be looking for opportunity to sell. We shall be looking for opportunity to sell. And let me take you to this quickly. Let me take you to this. So this is how it looks like. So we have three trends that are tradable in a market. Three trends, three market directions, three market patterns, not chart pattern, I mean market patterns. So we have when the market is buying, forming higher highs and higher low, it is bullish. When the market is forming lower highs and lower low, it is bearish. Then we have the third category of market. When the market is moving sideways, we call it sideways market, or we also call it ranging market. When the market is forming when the market is between fixed resistance and support, when the market is not passing a particular resistance and it's not going lower than the particular support. The support is like the floor of the market, while the resistance is like the ceiling of the market. It's like you are in a room. You're not jumping above it, and you're not going lower than the floor. So when the market is just opposing between a fixed resistance, the ceiling, and a fixed support, the floor, it is said to be a ranging market. So the market is not moving up, it's not moving down, it's just moving to the right side, it's just moving sideways. So it is called a ranging market. These are the only three tradable markets that you can make profit from. The fourth category of market is called choppy market. That's when when the market is just, it has no direction. You open your chart, you open your computer to check the market, and you're not seeing any clear direction. Just close your computer and walk away. Just walk away, because if you try to trade a choppy market, you might end up losing your money. So these are the three tradable markets. Uptrend, downtrend, and ranging market. Uptrend, downtrend, and ranging market. And you must understand that. So you have the uptrend, you have the downtrend, you have the ranging market. So when the market is going to the top, it's called uptrend. When it's going down, it's called downtrend. When it's between fixed resistance and support, it's called a ranging market. Are you with me in this class? Are you still with me in this class? If you are with me, type 3 in the comment section. If you can still hear me, and if you understand what I'm saying, just type 3 in the comment section. I'm waiting for you. Type 3 in the comment section. Type 3 in the comment section. All right. So let's continue. So let's go deeper. Now, there are three ways to analyze the market. Three ways to analyze the market. We have the technical analysis. Technical analysis. By technical analysis, we mean when you use your charts, when you sit behind your computer and you use your candlesticks or whatever market language that you're choosing, whether candlesticks, pattern, or line chart or bar charts. All of those, I'll be exposing you to them later on. And then if when you're looking at your computer and that's all that you're using to take trade decisions, entry and exit, you are doing technical analysis. And this is where we're going to be spending a lot of time. Under here now, I'm going to be teaching you a lot of things. Make sure you don't miss the class. This is where we're going to be spending a lot of time. Then after that, we spend some time here too, and then very little time on sentimental analysis. So now we have fundamental analysis also. This is also very, very important. This is when you begin to consider the economic data of countries, of country of the currency pair that you are trading. I told you, see, that when you trade euro, when you trade euro USD, you are trading between the economy of two most powerful countries in the world, the Europe and the America. Okay, so now whatever affect America's economy will affect your your trades on Euro USD or any currency you are trading that has to do with USD JPY. Whatever happened to the economy, whatever prosper the economy. So when the economy is booming, that currency will be appreciating. The currency will be appreciating. This affects every country everywhere. For example, if you're in Nigeria right now, you discover that our currency is just it has depreciated to a level of $1,400 to $1 to $1, $1,400 to $1. That's a massive depreciation. A couple of years ago, it wasn't like that. A couple of years ago, it was 190 naira to a dollar. Now it depreciated. At some point, even in Nigeria, it depreciated to 1,900, and that's because our economy was bad, and or so whatever happens to our economy, it will affect the currency, the value of the currency in the global market. So very important. So that's fundamental analysis. Fundamentally. So when the government policy begin to bring back economic improvement, the currency will begin to appreciate. The currency will begin to appreciate. So we can now say that naira has appreciated from 1,900 naira to a dollar to 1,400 naira to a dollar. That's appreciation. Appreciation of almost 500 naira. Appreciate. So it's appreciating. So when the government policy begin to get better, the currency gets, more valuable. Appreciate, and then that's fundamental analysis. We're going to use the data, the policy decision. We're going to view the polity or political decision, and then it affects the country. Sometimes Donald Trump will just come up one day and say he's putting a tax sanction on a particular country. Look at when he did this sometimes ago on China. Within few hours, Japanese yen depreciated massively, massively, as it was very crazy. All over the world, people were screaming and shouting. You will see the red candle just going down, pa, 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 because the president has said something. I think that time he said they are putting 100% tariff on China, and China spent JPY, that's Japanese yen. Oh my goodness, it really, really, really affected China massively. I was looking at my child like this, everyone, pa, 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 pa. And we were all buying that time. Of course, we were already trading at stop loss, so the thing just eat the trailing stop loss where we have locked some profit, and then it crazy, massive sell candle, red candle just falling down. So that's fundamental analysis. Then we also have the sentimental analysis. Sentimental is about being biased. It's about it's sometimes it doesn't have uh, concrete evidence as in printed document to uh, base your assertion on, but it's just sentiment, just sentiment, just sentiment. Like for example, now in Nigeria now, until the last 2 years now, every time in Christmas time, the price of fuel always goes up. The price of fuel always goes up. The price of fuel always goes up. And then you see that even on Christmas Day, there's always very long queue at the fuel stations. Long queue at the fuel station. Of course, that changed 2 years ago. But imagine in those days, everybody starts saying, "Oh, fuel will get expensive and get scarce at the Christmas time." People start buying and hoarding, and that happened for many, many, many years. So even when NNPC has not reduced the supply of fuel to the Nigerian public, has not reduced and they have not increased the pump price because of sentiment, because of people's no data is backing it up, just sentiment. And then the price of this start going up. Something that happened to Japanese yen at Christmas time because there's so much more importation at that time more than any other time of the year. So these are sentiment analysis. But you see, we're going to be spending so much time on technical analysis and fundamental analysis. Then very little time on sentimental analysis because sentimental analysis does not always last. It doesn't really last. It just is usually temporarily. And so that's how our class is going to grow. So technical analysis now, if you have to begin from here, are you still with me in this class? Are you still with me in this class? All right, beautiful, 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 beautiful. So let's continue. Now, Technical analysis. In this session, you'll be introduced to technical analysis to help develop foundation needed to understand simple technical concept in trading. Okay? And then the technical analysis is the study of past price activities in order to forecast the future price movement. When you study the past price activities to forecast the future price movement, the future price movement. It is the study of historical price movement, and remember that history has a way of repeating itself. Now, yesterday I said is to say I am a retail trader, trend is my friend. The one I'm going to be teaching you today is that you will type in comment section, history repeats itself. History repeats itself. I like to type in the comment section. Yesterday was trend is my friend. I'm a retail trader. Trend is my friend. Today, history repeats itself in the comment section. Just type history repeats itself. History repeats itself. Type it boldly in the comment section. I'm waiting. History repeats itself. History repeats itself. Have you typed it? History repeats itself. Type that in the comment section. I'm waiting. History repeats itself. All right, so let's continue. I'm also trying to load my MetaTrader so that I can show you charts, so that I can show you a practical market. But so technical analysis is the study of past price activities in order to forecast the future price direction. It is the study of historical price movements, and remember that history has a way of repeating itself. So the primary aim is to focus on the statistical analysis of price movement in order to understand price action evolving into trends in the market. Okay, so we have technical analysis, other technical analysis, we have you identify the trend, you have indicators, you have moving averages, you have support and resistance, you have indicator, we have candlesticks. That's what price that those are the things we'll be spending a lot of our time on subsequently. 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 Okay. Oh my goodness. Okay, I think we have this now. So now, so let's go deeper now. So we said, going back to 19th century, the father of technical analysis, Charles Doe, observed that it is the direction of peaks and troughs that determine the trend of the market. It is the direction of peaks and troughs that determines the trend of the market. So let me see if I can share with you let me share with you my screen. Okay. Let me share my screen with you now. All right, can you see my screen now? All right. This is how your chart looks like. Okay. This is how your chart looks like. So let's end today's class here explaining our chart to us. So yesterday I told you to open an account. To open an account, okay, you go to www.apicts.net. Okay, you go to this site and click on the Reef icon just at the home page. Don't register on that website, but just click the icon, the Reef icon, click on it, register a Reef account. Click on when you complete that, then click to Hot Forex. Click on Hot Forex, register Hot Forex account, then click on Xness and register Xness account. So these are the three accounts I want you to open. The first one is open Deriv account. Open Deriv account. Open Deriv account. Then you click on HFM. You click on HFM. It's called Hot Forex. Open an Hot Forex account. So they actually call HFM now, but it's the same Hot Forex account. Then you open Xness account. Xness account. You open Xness account. Okay, open Xness account. So when you are done that, it will give you a login details. These login details, they will give you login details. I wish I can explain this on the WhatsApp. They'll give you login details in your email that we use to open these accounts on your phones so that you can see the chart as it is on my screen here. Maybe I will spend time to explain that on the WhatsApp group. Okay. So this is how our chart looks like. Okay. This is how I make my own trading, my chart to look like strictly naked trading. I used to call it naked trading. I'm a naked trader. No indicators, no. Of course, I'm going to be teaching you a lot of things later on. Okay, how you can use indicator to trade and you can be a naked trader. My goal is to make you a naked trader where you don't need to use indicator at all when you are strictly price action trader. That is my goal. That is what I'll be, that's what I want to achieve for the purpose of this training. But then there are so many steps we need to pass through before we get there. Okay. So we have on top here, we have time frames. We have the time frames. Now, if I click on this now, this is 1 minute time frame. it means each of these candle is taking 1 minute to form. Before then, let me show you how you come about this screen. Okay, good. Don't worry. This is 1 minute time frame. Every candle in this place is what happens in the market every 60 seconds. What happens in the market every 60 seconds. And then when I come to this place, I have my 5 minute time frame. 5 minute time frame. That means each of these candle takes 5 minutes to form. This is what we call candlesticks. Candlesticks. 5 minutes candlesticks. 5 minute candlesticks. Each of these candlesticks is taking 5 minutes to form. Then if I click on M15 here, M15 means 15 minutes. Each of these candles is taking 15 minutes to form. 15 minutes to form. Then if I come to M30, that's 30 minutes. Each of these candles is taking 30 minutes to form. 30 minutes to form. If I click on 1 hour, which is H1, it's telling me that each of these candles is taking 1 hour to form. Then we have the H4. H4 means 4 hours to form. Then we have the daily time frame. Each of these candles is taking 24 hours to form. Then we have the weekly. Each of these candles is 1 week candle, 1 week candle. Then we have the monthly. Then it means that every candle you are seeing in this place is taking 1 month to form. That is what that is talking about. Then we also have instead of candlesticks. See, before people started using candlesticks, we have other what we call market language. What I call market language. This is a line chart. Line. People are just literally using line. Okay. Let me change the color to black. I don't know if you can see the line. You can see this line now. This 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 is line chart. This is line chart. You see that the market is some people used to trade like this in those days. So when they use lines to determine their exit and entry in the market. Okay. Then after the line chart, they upgraded to the bar chart. This is bar chart now. See how bar chart looks like. Okay. And they used it until recent years when they now have a better, more detailed limiting our technical analysis to candlestick chart pattern. But then once in a while, there's an aspect of I like to teach using the line chart. And so this is the candlesticks. This is how candlestick looks like. This is how we're going to be studying the anatomy of candlesticks. Like I told you yesterday, we're going to make progress again tomorrow. Make progress again tomorrow. It's very much likely I'll be doing a pre-recorded video for you before class tomorrow. Okay, so this is where we're going to be stopping for today, and we'll continue again tomorrow. Make sure you log into apicts.net, open your derivative account, open your Forex account, XNet account. If you have already opened all these accounts on, we'll continue this further on the WhatsApp group, because tomorrow we'll be trading together. We'll be going deeper on how to enter trade, and you will need your accounts on these brokers. You need your demo accounts. So have a demo on derivative account, have a demo on authorized account, have a demo on XNet account. Then we'll continue tomorrow. We'll continue from there tomorrow. So I like to pause this class at this juncture, except you have questions. Do you have questions? Does anybody have questions? Do you have questions? Does anybody have questions to ask before we end the class? Or if you have questions, drop a question on the WhatsApp group, then we answer it there. Thank you. See you in class tomorrow.